here to start up today's webinar. Bill, thank you so much for joining me.
My pleasure.
So for our audience out there, Bill White is the CEO of ClearList. ClearList is the equity marketplace for private companies that's transforming the price discovery of private securities, redefining a path for private companies to the public markets. Prior to ClearList, Bill was the managing director of GTS. He also served as managing director and head of product development and platforms for markets at Barclays. He began his career as an independent trader on the CBOE, where he built an options trading platform. So we're noticing a lot of technology involved in your experience here, Bill.
Yep, trading as well.
Bill has over 25 years of experience in the markets and has extensive understanding of market structures, technology requirements, and risk controls needed to ensure successful execution. So let's get started.
Great.
Bill, we were talking a little bit before we started the webinar here. Traditionally, one of the challenges for investors in private securities is the inability to gain liquidity, particularly today with companies staying private longer, and may lead to some of our additional questions about IPOs as we get going. What's ClearList doing to solve the problem of liquidity, and why is the timing right now?
Yeah, good question, and thanks for having me, Dennis. Appreciate it. It's a very broad question, and throughout my career, we've been asked the same thing. My background trading. I ran the largest specialist on the New York Stock Exchange, which is really a lot of the strategy around ClearList as well is what is liquidity. When you're a market maker, you're trading 2,000 names. Quite honestly, the top 200 are your business. The bottom, 1,800, the bottom 1,800, you're just trying to pray that you don't get run over. And really, that's capital formation. And that's the same thing you see in the private markets as well. Is really how is capital formation and how is it happening? There's companies with social following, and there's companies that are good products, but the audience and the understanding of that product is very small. And so what we've gone after is really what we think are the holes in the private market is really the cost. How are these transactions going up when you're having two-sided brokers, trading these things with 5% commission on the side? That's really not how capital formation happens. And that could be change the valuation of companies and understanding about what really is the asset value. Two is the transparency. So when that price formation is currently happening in the private markets, how is that price getting baseline? Meaning, if a stock is offered at $20, where am I seeing that? Where am I knowing where I'm able to come in and bid? If you look to a lot of these secondary platforms that are out there, it looks to me like a sell-side trading desk of a bank, where you're trying to solicit interest in a name, calling around and trying to, create that price discovery via, that auction process. So really having the transparency is what we need to bring to the market is really the foundation of ClearList as well. And access, as a broker dealer, giving that broader access to that auction process. So if it's just, again, a solicitation of a small group, or you're using a web-based portal to push out deals, how is that access actually happening? And how do people understand what the process is? So I think, really that's the foundation. What we talk about is simply the cost, the transparency, and the access to this market to be able to really demonstrate a price development or a price formation for these assets. And I think all those together is really what we're trying to do. And it's been around forever, right? If you look to various points in the market, look at the financial crisis and the dislocation in price formation from all assets during that period. That was a point of really access to those deals. When you see Warren Buffett step up and buy $4 billion of Bank of America, not a lot of people had access to that trade. When we were trading, we were a specialist on the floor during that time, and the SEC came out with a no shorting rule. Well, only person that was able to short was the specialist. Well, I will tell you that's a good seat to be in. So you've had a disruption in the actual normal flow of liquidity into the market. That's what's happening in the private market. So what we're trying to do is bring what we talk about as the best in the public markets and bring it into the private markets to have that open, clear auction process, so assets are valued properly and that transfer of risk can happen seamlessly.
And are you setting those auction prices to start?
No, I think what we do is, with our ability and our market making backgrounds, we have the ability to understand fair value and calculate fair value, which we talk about clear price, and eventually having that as somewhat of a benchmark as the center of liquidity formation. But really what you're trying to do is let a public auction come. If you have an interest in that name, that you could publicly out loud saying, hey, I like this name, I'm going to bid $20 for it. I could see the relevant information. What was the last capital raise? What's been happening in the secondary market? That you can make a decision, go out publicly and say, I'm willing to buy that at $20 and have that transaction happen. That's what we talk about as you really being very open and transparent. So what if you come into the ClearList auction process, it looks like you're logging in your TD Ameritrade account. You're able to represent your bids and your offers out loud. If it's an auction, you're able to represent efficiently, understanding the rules of the auction and understanding that you have equal access to anybody else on the street to be able to trade that product. It's not only good for the investor, it's good for the company to make sure price transparency is happening in an efficient manner. Meaning, what's the worst thing for a company? They're out trying to raise capital, and you're hearing in the secondary market that their shares are trading 10% lower where they're trying to actually raise capital. That's not good for anybody. If the real reason it's down 10% is because of anything to do with the company, that's great. But because of an inefficient secondary market, the company shouldn't be penalized. And, that's the kinds of things we're trying to attack.
Interesting. From your experience, what are the current impediments to investing in private companies today, and what can be done to improve it?
Yeah, I think, what we talked about above, before is really just the access to the market. But, I would say there's other things. There's really, you're seeing, it is a risk to transact in the secondary market right now. There's no clear settlement process. And I think if you look to some of the larger parties in the secondary market, if you look to the rest ones in the risk profile, it's lawsuits, meaning, you think about what happened in WeWorks. You and I, prior to that information coming out, I'm trying to buy WeWorks from you. Next thing I know, you see a complete corporate failure. They're redoing the board. They're throwing out the CEO. There's a new price level for that company. Everyone's looking for me. The buyer has gone away. So that's not an efficient market, right? Because the only way to actually have a easy transfer of risk is have a guaranteed settlement. So I think that's been a broken part, that without having understanding of the settlement process and having it seamless, nobody's taking risk for a 45-day settlement window. It's not anything I would actually sign up to. So for ClearList, again, when we have the shares available to transact on the platform, we will actually guarantee immediate settlement of that transaction. And I think that's going to be the differentiating factor. The market will move in that direction because, again, as I said, if you go to look at any of the larger secondary platforms, that is one of the risks, and they're struggling with it. And, for our model too, is working directly with the issuer to make sure we understand what the rules of engagement are, let them participate in the price formation and the risk transfer of their investors, bringing them to the table and make sure you have, the ability to those shares to be able to be, put into custody and transact. That's a big thing. So, our client is at the end of the day, the issuer, to make sure we're operating on their behalf, even if that block is coming from an outside investor, to make sure the company's at the table, understanding what the risks are, and let them have the opinion, how many new investors they want, should there be a bottom on that transaction? Are they doing a raise? Let them be part of the process. Eventually that's how we're going to win the business, being very issuer centric.
Now, it's interesting. Is that not common with other secondary?
No, obviously from a primary, yes, if you're out raising capital, you're raising on the company's behalf, and, they're going to have opinions of who's coming onto their cap table. They're managing the size of their investor base by, simple, how much notional will they allow you, minimum notional investments in different vehicles like that. But currently in the secondary market, I'm able to call up one of these brokers and say, hey, I want to buy XYZ shares. There you go on and possibly find the other side. The company is completely outside that. And now what do you have to do? You have to go to the company to clear it. You have to go to the company to make sure there's no ROFR and that needs to be released in the appropriate manner. A lot of structures, SPVs, forward contracts, options have been around, and there's ways that companies have tried to move around that. But I will tell you, having direct dialogue with the SEC, that's part of their concern, is really to make sure the understanding of the ownership of these shares is very well defined. I think you've heard Gessler talking about even looking at private equity. If you have a private equity firm with a large block of private shares and they have 100 investors, Is that one investor or is that 100 investors? So you can see the detail where he's driving at is really to understand that a cap table has limitations for how many, investors can be on that cap table before they're reportable, but really diving in to see to make sure this market is efficient, make sure there's no other, possible moving around the current rules in the market. And you can see where he's going with it. And I think that's more of a macro question, but definitely that's the part of it he's looking at it. What is the true ownership structure of this company? And to make sure they're not going around any of the current rules.
Interesting. Now, ClearList, are there particular stages that you want to work with companies? Are they late stage, early stage? Does it matter?
Yeah, I think, coming out of our background, when we looked at the model, we definitely believe that we will be the late stage environment for trading. We already have the expertise, the technology to run, a specialist business. I've done hundreds of IPOs in my career from that point of sale forward. We've always looked at it. There's no difference between trading that product 30 days before, 60 days before, 90 days before, and helping with the price formation and giving companies other options to go into the public market. But what we've built at ClearList now is really the end to end. There's nothing that we can't do for a private company, from the capital, from the cap table to the primary to the secondary. We're a transfer agent, so we're an investment bank, we're an exchange, and we run all the peripheral tools that are needed to be able for them to operate. So we have companies coming in that are getting ready to go IPO that still need their cap table restructured, to seed companies coming on with 10 investors that want to start out with a cap table, looking to us to help them possibly raise capital, looking for us to use the tools of our entire process. So no, we've engaged with companies at every level, because once they're in the platform, as I said, there's nothing we can't do for them. So you're hoping rinse, repeat. They go out and do a raise, we're updating their cap table, we're there for them, all the way through hopefully going to the public market, which we could help them facilitate. Quite honestly, in the public market, we could manage their ESOP plans, their options plans in the public market. And really, I think, there will be a point, even in the public market, when the company does a secondary transactions, they could utilize the tools that we built in the private market to go out and solicit in the public market as well. One of my biggest complaints always is, you're a shareholder in a stock and you see them do a large secondary, the stock's down 10%, nobody called me. There's got to be a better way of doing it. And I think you'll see over the years what's happening in the private markets. There are tools that could be actually very relevant in the public market as well.
So, it sounds like the goal of ClearList is to be a life cycle company. Work with them from early on through up to IPO, ideally, but it sounds like even beyond IPO.
Yep.
So anyone that's out there listening that was worried that they might be too early, it's probably a good idea to get in touch with you sooner rather than later, so they can start working with you.
You're welcome all.
Welcome any and all. Perfect. What's the long-term goal of ClearList? Is it to help private companies to an IPO? It sounds like that from when we're talking.
Yeah, I mean, obviously we want to be, to create that very efficient, disruptive, end-to-end process for them. So, we've seen it through our careers. I always use remember ARCA. ARCA comes in, here's this electronic trading platform. The first day there's 25,000 shares of Microsoft blinking. Nobody knows how to trade on it. 6 months later, they have 20% of the US market share. Technology is actually changing how this happened. When I came into my career at the SIBO, they were going electronic. We built our first electronic options trading model. That turned into my model, which I brought to the New York Stock Exchange as they went electronic. Now we're in the private markets. It's the same concept. How do you generate liquidity? How is pricing formation? So it's very consistent across what we've seen time and time and again in the markets. I think it moves a lot quicker now. There's different optionality. There's tokens. There's different things we'll see brought into the market. Settlement, T0 is a big talk about how to do same-day settlement in the public market. So this evolution is just not nonstop. But to me, there's no difference between the public market and the private market. It's just what tools are efficient. And as you said from your first question, liquidity formation has to happen in a very cost-effective, transparent market with open access, or it just isn't going to work. And I think that's what we're trying to do is, we're willing to, go after, these high commissions and making it seamless for a company to offer shares. So if I have a client on my platform saying I'm looking to buy XYZ shares and they're trading somewhere at a lower price, shame on the market, right? So that's the same thing with Reg NMS. What was that about? So the New York Stock Exchange wasn't trading below NASDAQ to make sure that price is protected. It's the same concept in the private market, and we're going after that with that price transparency and driving people. They're going to have to come to our platform if we have a better price, and better price includes costs. So without the commissions being 5% aside that's currently in the market, taking them down to virtually nothing, that's a big disruptor, and driving efficiency to that market is really what we're going after.
It sounds like the key from listening to you is the technology that's been in the public sector markets needs to drive into the private sectors.
Exactly. Right, exactly. And again, there's a difference between a company that's doing an A round and what needs they have. I don't recommend a company do an A round and next thing you know, they're letting their shares trade in the secondary market. It's not an efficient way, because what that company is going to need to do a B round as well. And part of the thing is you don't want your shares just freely trading, but there's companies that do B rounds and they're very successful and their revenue grows into it. But now you have employees with needs. There's capital needs of your employee. You want to let them have liquidity. How do you want to do that? You don't say go out and start trading yourself. You manage it in a very efficient manner. And I think for us, working with the companies to say, listen, we'll allow your employees to offer their shares on the platform for no cost. So if they're offering $100,000 worth of shares, they're going to get $100,000. And I think that resonates well with companies. And we're going to protect you. What are your concerns? Well, we did a raise 6 months ago. We don't want to trade below, or X or Y, that we can set up a structure that's going to be very comfortable for the company to let their employees execute. Again, they're driving what the rules of engagement are, but this is going to continue to happen, especially look at what's happening in the market now. You're having this massive risk off. We were, last fall, every day we walk by the New York Stock Exchange, there's a new banner up there, somebody going public. You might not see a banner up there for 6 months. So the needs of those markets are going to change, right? That issue of employees looking for capital is real. Unfortunately, some of these companies are going to go up at discounts to their last raise, and they're going to have to understand that, but that's part of the capital markets. You can't just let your employees suffer because that you have to do it in an efficient manner. Understanding every risk asset has been devalued over the last month or two. So you'll see a transition that, companies are going to have to start thinking about it. Employee retention, we've talked to some very large companies that will tell you that they've lost quite a few people being too strict on holding, their employees to not selling shares. And I think, the street has changed, the world's changed, and thinking, okay, we need to understand what that means. As I said, ClearList could step in any construction of any liquidity event a company is thinking about, we could actually do on their behalf. And I think that's where we're unique as well. Again, employee first, protecting their capital, working with the company, helping them protect who their new investors are coming onto the platform. That will resonate over time. And I think that's our message. And, the more we're telling it, the more traction the product's getting. We only launched really we received our broker dealers in February. We've transacted in every single parts of our business. Our cap table business is growing. Our capital products are growing. So we sit in a very good position to really be disruptive to the street. And, we're doing our first A raise as well. And seeing that side of it and engagement with the investor pool has been great. It's tiring, but it's been a great process because now we're living both sides of it. We're actually investing via our own products. So when you come in to invest, you're coming through the ClearList portal to be able to, do a primary into our company, which is pretty unique as well.
So you're going through the fun of capital raising. You're feeling the pain of your clients as well.
Oh yeah, I've met a lot of nice people. I'll just leave it at
that. Excellent. Well, I think your part on the employee liquidity is a fascinating aspect. I sold my company almost 6 years ago.
Mm-hmm.
At the time, the company that acquired me was at about $2.5 billion. Today, they're at $20 billion.
Wow.
I think always the talk of going public, but never have. So, for the employees, in that 5.5 years since and prior to me selling, they're always waiting to get that moment. How do they cash out? How do they get their value?
Yeah.
With this great resignation that we hear about, part of the package for staying is the stock options. But if you can't get liquidity in a reasonable time, it doesn't have that same value and meaning to the employees.
Yeah, definitely. And it's, quite honestly, it's intimidating for these employees. Like it's a tough question to ask. You can't go into the CEO and say, I have 3 kids in college, I'm equity rich, but cash poor. It's a reality. We had this one story that resonates with me very well is this company, it's probably a $2 billion valuation already. The secretary had been there since day one. She had options and they're worth a ton. And she came to the CEO and said she wants to get $1,200 to put a deck on her house. And eventually he's like, there's no process for me. I can't let her get liquidity out without the rest of the employees. So I think he just wrote her a check and built the deck for her. But that's a real story. And that happens a lot in these companies. As you say, that situation where you're moved from a valuation of X to Y and now you can't leave because your equity is too great. That's where I think these CEOs need to really, allow 3% or 5% and do it in a tender process or do it in an auction. There's value to the company as well. What I always tell the companies is if you construct an auction, suppose you allow your employees to sell 3%, you pool it, you do a single day auction. You can set the minimum. If it doesn't trade at the minimum, nobody knows. The auction never goes up. What happens if it trades up 15% as you see your one-day pop? Look at the amount of information you have as a company now. And that's what we talk about is the direct listing process. It's not like the company has to go out there and start trying to auction off shares. Utilize your employees, give them an asset, be able to manage liquidity, raise capital. Now you've got a toe in the water. Wow, our valuation's 15% higher than we thought it was. Maybe we should consider public options now. And that's what we're talking about is late stage valuation. That single auction, instead of a bank telling you you're worth 100, where we just did the auction and the traded at 115, say, you can go into the public market at a valuation of 115 and then make the decision how much capital to sell. Instead of a bank or somebody else telling you you're worth 90 and you open up, you sell 10% of the company and the stock opens at 115, there's a destruction there. And I think you'll see companies over time start looking to use that option. And it's going to be a lot of the pressures that you still see again in the public market. What happens every time a stock drops 50%? You have a class action lawsuit in, company didn't state financials right, we want compensation for that. You're going to start seeing that when a company sells a block 10% of their shares into the IPO and it opens up 60%. What's the question as a shareholder you're going to ask? What was the valuation process? Well, we went to a bank and they told us we were worth X. That's not going to be enough. There's other options available. Conducting auctions, putting your toe in the water, try to really let the market demonstrate what your valuation is. So moving into that public market will be seamless. That's where I see the pressure. Maybe not today, but over time, you're starting to see a few companies talk about it. You've used different manners to get into the public market. Coinbase did it. They did a weekly auction using that to drive their valuation going to the public market. So it's going to start happening, but I think there's going to be checks and challenges on board. Myself, if I were a large shareholder, would be asking that question. Why are we up 85% and you sold 10% of the company on a distribution prior to the IPO? That's going to be a check and challenge that they're going to have. When there are other options available, you have to be able to test them. And I think we believe, and that's what's going to happen. As I said, with our background doing hundreds of IPOs, I always look at the bell stand when they're up there clapping and the CEO says, wow, I just gave quite a bit of equity. It's great we had this pop, but maybe if I had other options, I would have considered them. There are other options now, and I think you'll start seeing more CEOs, challenge that.
And so it's interesting. You talk about the one-day auction. Do you see that as the more common, or do you see a continuous trading?
I think it depends on the company. Like, there's no doubt, a technology solution that's very hardware driven that nobody understands is different than, Twitter coming, or we just saw Sweetgreen is one of the examples that was just up massively. There's different, right? If they have it's a high profile company with believes there's going to be a lot of retail demand, that's something different. And we have to be clear that there's different situations. A very difficult biotech company is going to need research. It's probably going to need a bank out finding people to be there day one. But there are a lot of companies, most of the unicorns out there probably don't really need a bank to tell them they're worth X. The street is already demonstrating their valuation because they're raising capital at very high levels. They have the opportunity to exercise different optionality. And it could be, a single day auction, or, let it up and trade and let employees and different people de-risk. If you look to some of the largest asset managers out there, they love the concept of, being able to de-risk as they go towards IPO. If you look to the largest, they are heavy users of the secondary market right now, just for the mere fact that they do want to de-risk. And what are they going to complain about is really no transparency on price formation, and two, the commissions are excessive. So they love to see what's happening in the private markets, the thinking of other options, be able to allow them to de-risk as well. They're happy for the first day pop, but believe me, they wouldn't mind giving up 25% of their shares prior to make sure there isn't, they're not into a holding period after that they've got to wait 6 months to be able to transact out. Look what's happened to these shares. A lot of these high flyers last year are 6 months later now. There's been a massive price disruption that, larger asset managers are happy to take liquidity events very close to going IPO. So we need to figure out, ways to give them that option. And I think ClearList can fill that hole.
Excellent. I realized that to our audience out there, if you have questions for Bill, please type them into the Q&A panel here. I should have put that information out when I started, so my apologies to everyone that's listening out there. Bill, where do you see the private security market going over the next decade?
Well, I think, a lot of things we're talking about. I think there'll be consolidation. I think a lot of them will look like, I think ClearList, they'll have all the functionality. I think they'll look very close to exchanges. I think there'll be a very clear delineation between the private and the public. I don't see that coming together, that it's just a seamless transaction. I think there's a lot of reasons why they should be different. I think, my discussions with the regulators has always been that question of, how do we get these companies to go public? How is that, what are you guys doing changing? Can all of a sudden somebody live on ClearList the rest of their lives? I don't think that's the right answer. I think there is a value for a company going public, having boards have responsibilities, that CEOs having responsibilities. You have that obviously in any market, but there's a different, right? There's a different stigma once you've crossed that line. The obligations in the public market, they have to be there, right? We need, checks and balances on these companies. So we believe in the formation and the capital formation and the movement into the public markets. I just think there needs to be, more, innovation there. As I said, the cost of 5% aside, really no, price formation and access is crazy right now. I'm not the one to say, there's going from 20 to 500,000 private companies, but there is, there is innovation coming to the market. It's consistently coming to the market. And we just need to make that path easier for these companies, for their employees, for their investors. I think all the regulators have talked about broader access and what does that really mean and how do we control that to make sure it's, you don't want a retail investor just hitting every crowdfunding opportunity they see. Like, how can we draw, a very inefficient process? And that's what we're trying to offer these companies. And it will migrate. I think the platforms will come together. I think there'll be a lot of consolidation, but it will be a very defined process, I believe, private into public. And, we're hoping to be the driver of that, that movement.
Excellent. We got an audience question here. How does the market set the price? Or if the company sets it, how do you help them determine it?
Yeah, that's a good question. I think, I'll use an example that we just recently worked with a company, and I think it really talks to how the market could be, could evolve. Like, we did a company, it's been in the press, so I could talk about Gatsby, a very up and coming, Robinhood-like option platform, very innovative, great CEOs, co-founders, and they were doing a capital raise, which we participated with. We were able to raise capital for them. They came back a month later and said they had a situation. One of their shareholders was acquired by a bank, and the bank was not allowed to hold those shares. So what's the concern for that company? Just what we talked about, that they just completed a raise. They probably were going to have to do another one. What if it traded down 30% from that last raise? Their ability to raise in the short term was going to be very well, very compromised. So for us to be able to have liquidity providers and understanding that they would just came off, they had seen the opportunity, were able to step in and bid on this auction. We were able to trade it in a single day auction. The shares traded up, substantially, printed the trade, protected the company. They knew exactly what the process was going to be. updated their cap table, they were able to go on to the next trade. So having that opportunity to come in and work with them and understanding how that process would work, again, a young company, strong demand on the capital raise, we're able to use that momentum to help them, move really a situation which wasn't really affecting them directly, but indirectly a secondary market with not an efficient process to give them that optionality could have actually hurt the company. So, great. It's the story of what we're talking about. Here comes a company to just transact on our platform using us from a capital raise position. We stepped in and helped them with an auction process that could have really actually hurted the company. So here, a young company, as you talk about when they come in, it's every level. And here's, a very young company that had to use two of our, very, capital raise is an important part of the process, but the secondary auction was a very important, part of the process to them. That to me is the success that ClearList could bring to other companies as well.
And did you find was that helpful, getting that valuation set to help with that additional capital raise that happened right after or at the same time?
Yeah, well, definitely, because we already had interest in the demand, so people were able to see, hey, they're raising capital. It was subscribed very quickly. That meant, the people that were invited into the auction, it was, broker dealers like, hey, they just did a capital raise. Our understanding was very well oversubscribed. That obviously moved into the auction process. The auction traded higher than the last valuation. Now, from the company's perspective, again, they had nothing really to do with it. They had one shareholder that had to transact. The company didn't buy the shares back. They transacted in an open auction and they traded up substantial from the last raise. So now they know, wow, our valuation is actually up higher than we thought it was. There's an asset to them that they wouldn't have had without conducting that auction. That same story is what we're talking about later stage, using the market to be able to say, if you open it up and give access, the demand might be stronger than you think. In that situation, it was clearly the example. And, it was a success for, ClearList and Gatsby to help them, move through that transaction.
Yeah, I was thinking about it from an investor standpoint. It's got to help give you confidence that you're investing in at the right valuation to know that as this auction happened, this wasn't set by the company putting some value on there and some estimate that how do we prove it or match it? This is what the market says it's worth.
Yeah, and that process could happen across the entire liquidity stream. We had done a tender for a large company, and the same thing. The company is coming out of a fundraiser, trying now to give access to their employees to take some capital off the street. But what's valuation? Do you do last raise? Do you do buy the shares back yourself? We offer all the optionality. So you can say, hey, we're going to take 20% of what the employees are selling and do a single auction. Then use that price as a determination of where the company possibly buy back the shares, or let the whole thing trade from an auction. So I think what we're trying to say is the optionality and the list of optionality that we give companies is how this is changing the entire market. And again, instead of allowing them just go to a very open, non-rule based secondary market, constructing the rules, understanding the rules of engagement, understanding how it's going to work, what rules of engagement we can put in place, driving commissions down so we're protecting their employees. That's giving the optionality and the price discovery that is needed in this market. And that's our message to these companies is, control the process, get involved in the process. Instead of your employees going around selling forward contracts in their current holdings, let them have that optionality, but take control of it, be partners with them. Again, from an employee retention strategy and a price formation, as I said, the company can get a value out of that, and I think that's the important part of it.
Yeah, that employee retention is a hot topic these days. On top of everything else in capital raising and valuations, employee retention is so critical and key.
Think about how many companies were in the IPO queue for the next 6 months that just went blank. And that happens all the time, right? We see movement in the market, and you don't see an IPO for 3 to 6 months. But as we say, there's a lot of capital needs there that could be, helped in the market. And I think, that the rules of engagement are getting better. Products like ClearList coming in the market are going to help with that. So that's the evolution that's going to happen, because you're always going to see this capital markets freezing and opening. But in between those highs and lows, there has to be other optionality. And I think that's what's changing the market. There are some great strategies that, we could offer that companies are, starting to engage and understand. And, the CEOs and the CFOs are, hearing these stories and understanding that, wow, we don't have to wait for an IPO. There's other things we should be considering for our employees. I think that's important. We're going to keep pushing on that.
No, that's great. We have another question. How do you aggregate and also segment buyers on the platform with an appetite for companies at such a wide range of stages? Additional question, is there a lot of crossover in your base who have an interest in Series A companies as well as late stage pre-IPO companies?
Yeah, I mean, that's a good question. I think what we're doing is really, exploding our base. So, we're any broker dealer can transact with the platform. We're a broker dealer as well, meaning if you're an employee of a company, you need a broker dealer, we could step in. But, I think there's not just a standard rule, from an A raising, there's A plus abilities now to go out and do A plus rounds that you can actually be in retail. That's a different pipeline than, an A company that's raising $100 million that's looking for strategic investors. And it's really for us to understand, what that company looks like. Who are they looking to engage with? That's the discussions when a company comes in and says, where are we going to go with it? Our question then was, what is your investor base? Who are you thinking to go to? Which we, help them get to their investors, but what are the core investors around that we could bring to the table? And that's for us is continually to build out our platform and our distribution network. So, there's deals we'll look at and say, listen, it's just not right for us. We don't understand the product. The diligence on it's very difficult. We don't understand it. We've actually taken opportunities and given them to banks to say, hey, take a look at this company, see what you guys think, and vice versa. Banks have turned around, companies and shown them to us that are at the level that doesn't make sense for them to do due diligence and push it out to their wealth network. It's not large enough. So we're trying to be that non-conflicted party that could sit in between the entire street. So, it's not likely that Goldman's calling up, Morgan Stanley's wealth desk to say, hey, we have this great block. ClearList could sit in between in a very easy manner, transact between those two parties. So we find ourselves in a non-conflicted position. The streets, the companies, they're all our clients. We're trying to make the best and seamless transfer of assets, risk assets that we can. So, our network continues to build. Every transaction we do, builds it larger. We're working with two very large blocks right now that are going to be very, I'd say, well-known, public friendly, that getting those deals out into the market, executing them on, you build your network even larger. So, we do have, if you look to our partners, we do have a very good distribution network and it gets bigger every day.
That's great. We are coming up on the end of our time. So if there's any more questions from the audience, please submit them. I have one more question on my list was, now with the Reg A 2, Tier 2, new issues are available to all classes of investors. How's ClearList plan to play a role in giving retail investors the ability to buy and sell private securities?
Yeah, we're definitely in the space. We are a transfer agent. So we do have clients that have interest. And I would use the same description. So we're bringing our first client we're working with right now to go through the process, getting its SEC approved. So I imagine it'd be about 2 or 3 months down the line, we'll get them out there. But here's a company that is very uniquely positioned. Again, has a massive social following, a very innovative fintech type product. So you see with those companies that have done it, if it's that type, they have a social following, it's disruptive, it's interesting technology, they expand their client base. So the new investor is, I want to use the product and I'd love to invest in it as well. And you're talking investments of $300 to $500, but $300 to $500 adds up if you do it, thousands of times. So that type of tool for these companies is very important. So we will be, going down with our first A plus in short order. I said the company is doing very well, raising at this early stage, unique model. Social following is substantial, so it'll be, I think, a very successful. And now with the ability to raise up to $75 million, that's a pretty big, pond to swim in. They'll probably be looking to do in the range of 20 million, but it's a great product. We're going to support it. Again, we think it's a good tool for certain companies. Again, not all companies it would make sense for, And as I said, when we talk about having the ability to do anything for any private company, that's part of it. We need to be in that space and be able to distribute, those deals out to the street. And so we're excited about it. And, we think it's a very unique product that will, be readily used for those companies that match that criteria.
So we got time for one more question. It just came in from the audience. Is how's ClearList better / different from NASDAQ private markets? And in what situations would I choose working with you over them?
Well, all situations. One. Again, we're end to end, so there's nothing to. So we do primary capital raises. We have cap table. We have the full facility to do all this. So they're a trading platform. They do various parts of the entire process, but we do everything. And I think we are going to be very good at our primary raise business. We have been successful there. We'll continue to grow it. But, the cap tables, which have been, really monopolized business, there's different ways of doing it. We do it in a very unique way. We believe we're the only group that reconciles the cap table for the company. So we're positioning ourselves at every one of the steps. We're going to do it in a different manner. We're going to be very cost effective. So we're picking around and growing very quickly versus the incumbents, NASDAQ private markets and various other parties. We were on with a bank last night. We got that direct question. How do you differentiate yourselves? Again, even when you get to the trading part of it, if a company is doing an auction, the company is letting it freely trade, there's very few market makers in the business, and there's very few market makers in the business because it's a very difficult thing to do. The technology is very extensive. The understanding of how to do it is very extensive. There's very few people in the market with my background and my partner's background. And I think we always use the term, it's a lot easier to build an exchange than to operate one. And I think we're going to differentiate with understanding what market making means, capital infusion, and the tools we bring to the market are going to be differentiating. And I think that's, we launched with that. That was our mandate from the beginning, is to be that group that differentiates that capital formation. Now we have the end to end. So we think we differentiate in quite a few places with NASDAQ private markets, but we're enjoying the competition.
Well, I think that's a great way to end it. A great overview and the end-to-end solution. And I can say Trellis is proud to be your partner in this. So thank you so much for your time today, Bill.
My pleasure. Thanks, Dennis.
Thank you, everyone.